and welcome to the last edition of Targets in Focus for this trading week. Now today we're going to be discussing Asian Pacific currencies, and joining me to do this is Greg Gibbs, Senior FX Strategist at RBS in Singapore. Greg, thank you very much for joining me. Now the Reserve Bank of Australia was expected by some to potentially cut rates in November, and they didn't. What about the prospect of a rate cut come December? Is the trigger there for a December rate cut at this stage, considering the Chinese economy is showing further signs of improving?
There hasn't been any new information really to generate that rate cut, but certainly the RBA in their minutes that were released only recently still indicated quite clearly that they see room to cut rates. Plenty of people in the market think that the timing-wise will be right in December, provided they get just enough push from the data, and there is a lot of data coming out in the next week which could give the RBA enough reason to pull the trigger on that rate cut in December.
What are your thoughts on the IMF's consideration to grant the Australian dollar official reserve currency status? How would this impact an already strong Aussie dollar?
Well, I guess it does indicate that the IMF believes that the Australian dollar and the Canadian dollar are the next two biggest reserve currencies. And that's probably anecdotally what most of us think anyway. But I guess by and large it is recognising what the market already feels, and it does recognise that a lot of central banks around the world already own Australian dollars. So it may not really generate any new demand for the currency, but certainly does validate its position as a reserve currency. And the currency is performing very strongly, as we know already.
Well, according to the RBA's most recent FX Reserve Transactions report, the central bank continues to apply subtle downward pressure on the Australian dollar. What are your current short, mid and long-term projections for the Aussie dollar, US dollar, and what base case scenarios have you built your forecasts on?
Well, I'm forecasting a weaker Australian dollar, mildly weaker. I have it trading at 1.02 year end and through to Q1, and then weakening towards the middle of next year and into the end of next year below 1, with a forecast of 99 in the middle of next year. My base case scenario is that we've already seen quite a significant fall in the terms of trade in Australia, and that's impacting on confidence in the resources sector. I think that's going to continue to play a capping role for the currency. And as we get through into the middle of next year, I think the concerns over the investment cycle will increase, providing more reason for the currency to weaken. And towards the next year, I'm also thinking the US dollar could start to perform well. I think there's certainly some room for some upside surprise for the performance of the US economy. So I accept that there is a risk that my forecasts, certainly in the early part of my forecast profile, a little bit below what may happen, but there's certainly also a number of risks to the global economy. And even though there's a newer safe haven demand for the Australian dollar, I think if risk aversion does rise significantly, if we see concerns around the European crisis rise and the US fiscal cliff remains an issue for the market as well, we can see the Australian dollar come down again. And as you mentioned, the Reserve Bank of Australia is probably acting subtly to cap the currency. So I'm sticking with my forecast that it does come lower from current levels towards that 1.02 in the first quarter next year.
Moving on to the Kiwi dollar, naturally the New Zealand dollar was also boosted by the latest China manufacturing PMI report. In this current trading environment, Greg, and against a weaker global outlook, how do you foresee the New Zealand dollar US dollar trade over the next 12 months?
Well, I always like to look at the New Zealand dollar through the prism of where it sits versus the Australian dollar, because the two will tend to move together. In the near term, we are facing an interesting monetary policy meeting from the Reserve Bank of New Zealand. The market's currently not pricing in very much risk of a rate cut in New Zealand, but I think the risk is actually higher than what the market's priced in. So in the near term, I see dovish comments from the RBNZ with their very poor or very weak employment figures out recently, plus also inflation numbers being quite low. So I think that can undermine the currency into year-end. And the next year, actually, probably not quite as negative on the New Zealand dollar through the course of next year, as I think agricultural commodity prices will continue to remain relatively high, and the agricultural sector in New Zealand will continue to provide support. So if we do get another rate cut or two in New Zealand, I think that will be it, of course. And I think as we go through the second half of next year, we may see the New Zealand economy start to outperform the Australian economy.
And finally, what about the upcoming elections in Japan and therefore the prospect of more aggressive easing by the Bank of Japan? How could this shape the movement of the yen over the coming months?
Yeah, look, I've been anticipating some weakness in the yen for some time, and it's now started. In looking at it again, I'm prepared to say there's still significant upside risk here for the dollar yen. Let's just talk about the fundamentals in Japan for a moment. Their current account surplus has deteriorated significantly, and that's likely to persist. The recent spat with China has had a significant dampening impact on their exports and industrial production and sent the economy back into recession again. So that's certainly problematic. I think there's increasing awareness of the fiscal problems in Japan as well, and certainly the politicians there have been changing their tune or shifting their tune dramatically towards a weaker yen policy for some time. More recently, I think the market is starting to take notice, especially with the election being announced and the very strident comments from the LDP candidate. And given that there will be a change of leadership at the Bank of Japan in March and April, it gives the government increasing potential to appoint candidates that will conduct policy as they wish. So all of that seems to be an environment where you'll get much more monetary policy easing from Japan, possibly involving buying foreign bonds at the same time as the fundamentals have deteriorated. So I'm forecasting 84 year-end for the dollar yen and continuing on to strengthen to 90 by the middle of next year.
Thank you very much, Greg, for sharing your latest FX projections with us. Now, coming up today on DukascopyTV, we have plenty of exclusive interviews, including the weekly wrap-up and the latest edition of the Press Review. So stay tuned, but for the moment, viewers, goodbye.